Hello once again and welcome back to the latest New Zealand property podcast and video series, and you'll see alongside me long-term invited guest to the show here, Matthew Gilligan from Gilligan and Associates. Welcome back.
Thanks, Mark. Pleased to talk to your listeners again.
We've been to get you back for a wee while because lots been going on with tax in the last 12 months or 18 months, but it's probably good we've waited along to this point because a lot of changes have happened in the last sort of few weeks, especially capital gains, etc., which we'll talk about shortly. But just briefly, for the listeners that don't know, do you want to tell them a little bit about Gilligan Rowe?
Well, for those of you that don't know me, my name's Matthew Gilligan. I'm a chartered accountant based in Newmarket. I'm also a property investor and property developer. And as MD of GRA, we've got around 110 employees here that are on my watch. And we specialise in tax and legal structures for property investors and business people, and also providing public education on property investment. As an investor myself, I've got close to 30 properties in Auckland. I also trade properties and develop properties. People around me enjoy that because they can tap into the experience I've got and just effectively copy what I do and get what I get. And a whole heap of us here, that is our pervading culture here at GRA. We're all investors, much like yourself, Mark. And you know, it makes us good advisors because we practice what we preach, and means we can relate to our clients, and what they're doing resonates with us because we do it too.
Now we talk about often this show about specialists having your people in your team having your specialist. This is one of the big differences of GRA and other chartered accountants are they, as you said, you walk the talk, but you do property. That's what you do. You have your property division within the parameters, and a lot of people feed off that and do very well. So all good. But we'll get straight on to it. Tax has been a major thing since the Labour-led government have been around, and we're just going to talk about a couple of taxes to start off with, and we'll go straight into. In fact, tonight we're going to talk about tax update and also an event coming up that Matthew and Gilligan Rowe are running called the Property Leaders Event on the 26th of May, which we'll come back to shortly. But first of all, there's people there wanting to know what you think about the tax guru about tax. So let's start with the bright line rules.
Well, such a roller coaster the last 12 months with Labor trying to, in a clandestine fashion, shoehorn CGT in with the purportedly independent tax working group with Michael Cullen as the chair. And I think everybody knew that was a patsy committee insofar as its independence, because we were supposed to believe that they would work out what the fairest system is and then bring forward their idea of the fairest system, and if CGT was a recommendation, then the government would consider whether it was the appropriate tax for the country. And then, of course, when the TWG reported and Jacinda Ardern, our PM for those of you overseas, turned down capital gains tax, and the whole country was astonished because she was so pro-CGT, an advocate of it. Out came Cullen, and he lamented that it was all undermined by Peters and that they'd tried really hard to get it through, and everyone knows that it was a very politically dangerous thing to do, and ultimately Peters had the last say. And it was fascinating because it revealed that he wasn't independent, he was pro-CGT. He was not there to work out what the fairest tax system was. He was there to get CGT in. And I base that on having read the article he wrote in the New Zealand Herald in late April. But anyway, CGT's gone. Amazing for New Zealand, really big turnaround, because the next election was going to be fought on that. And it's giving investors a layer of certainty, and I think it will bring certainty back into the property market.
Just at that point alone, we've had in the last previous months leading up to that, a lot of investors saying they're just waiting at the moment. They just weren't buying because they were waiting to see what's happened. And even in the last couple of weeks, there has been, I think, initially even a little more action happening. So people getting their head around it now and a bit more confidence.
Yeah, it was a confidence killer.
Yeah,
and crazy really, because it was never going to change anything long term other than make us pay more tax, because all the OECD countries, bar 4 of them, I think, have capital gains tax, and they've all got house price inflation. So it wasn't going to affect things long run, but it certainly was, like loan to value ratios coming in, the market died, and then everybody digests the information and then they re-establish. Yeah. But anyway, it's not coming in, and that's good news for investors. What we do have is 5-year bright line rules, and they've been around for a long time. National brought them in as 2-year rules, and Labor extended them to 5 years. And properties acquired after March 29th, I think it is, 2018, they have to be held for 5 years, or the gains are taxable. Everyone knows that. Some points that are a little less known, those bright line rules apply to New Zealanders investing abroad, so they're foreign properties. So if you sell a foreign investment, say a house in Australia, and it's a residential house, the gains are taxable if sold within 5 years on those overseas properties. Another thing that's lesser known is that the losses are also deductible on bright line assets. So residential property sold within 5 years, you make a loss, then that loss can be offset against other bright line income, so that's useful. To me, a significant bit of information about bright line rules is that they do not apply to commercial property investment. So that is a massive tax incentive to go by commercial. Anyway, bright line's done to death, so we won't do any more on that. Loss ring fencing is coming in, or has come in. It applies from the 1st of April 2019 for the...
No one knows the rules.
Yeah.
How's that for a government policy?
Yeah, it's quite extraordinary. So the legislative amendments have not passed through Parliament yet, yet we know that they will apply retrospectively from the 1st of April 2019 for the 2020 financial year. What these rules do is they say that for residential investment property in New Zealand, you can't offset the tax losses against other sources of income, including business income from, say, a company that's involved in trading, or a flower shop, or an engineering business, or any other source of business. You can't offset residential losses against those business incomes, or you can't offset them against salary. And first point about this is, apart from being a disaster and socially regressive, because this hits poor people the most, right? People with low income, low equity, or people getting their foot on the property ladder and they're just starting to get going. And so people who have the highest gearing, who are most vulnerable, are most affected by these rules. And I've said it in the media quite a bit, and I published it in New Zealand Property Investor Mag. I think when interest rates go up, these rules are going to be socially very regressive, because people who can't afford the spike in rates, the people further down the totem pole, they're the ones that really need the tax refunds to stay alive. And it's like the ability to claim tax on losses is like a steam valve in the market. When the market is affected adversely by a spike in rates, or even if you have a problem with repairs and maintenance, the ability to claim a bit of tax off that is what saves a lot of people. And the people it's saving are the people that cannot afford the losses. So ironically, the government that's bringing it in are actually hitting their base, the labour base, the hardest with these rules.
People who have saved up for 50, 60 years have finally brought their first home. That's legally geared because they've only got the minimum deposit they can do.
Millennials on their first investment property.
And property investors who own 100 properties who've only 40% geared.
Now this sounds like crocodile tears, but it doesn't affect me. I'm tax positive. 70% of the Gilligan Road client base, we've got 9,000 clients, 70% of them are tax positive on our polling. So I'll say that again, the bulk of the Gilligan Road client base, this doesn't affect them, because it's all investors that have been around for 1 or 2 property cycles or more. And of course, with interest rates so low and LVR requirements for the deposits being so high, who's not tax positive in this environment with interest rates low and big deposits required? Well, I'll tell you who's not tax positive. Mum and dad investors who are getting on the property ladder for the first time, and they're going to be smashed by these rules. So for that reason, I think they might be politically unpopular in the long run, and they could be seen to be socially regressive, and either a change of government or even this government, when they see their members being hurt, their constituents being hurt, could turn them around and repeal them. Wouldn't surprise me. Having said that, they apply to residential property investment, and what that means is that commercial is not loss ring fenced. And so once again, bright line rules not affecting commercial property. So you can sell commercial property within 5 years, it's not taxable. And loss ring fencing not affecting not commercial property. So 2 tax incentives for commercial there. I think commercial's going to have a better go in the next decade.
The question some people watching will probably have is, if you own a commercial property that's making you $5,000 a year, residential that's losing you $5,000 a year, can you offset the 2 taxes?
No, you can't. So if you've got commercial property and it's tax positive, and a residential property and it's tax negative, can you offset the 2 classes of asset? No. But if you've got a residential that's tax positive and a residential that's tax negative, you can offset them. But where it gets a bit murkier is the choice of structure. So if let's say the residential property that is tax positive is owned in a company and it's an ordinary company, and the negatively geared property is in another company and that's a look-through company, or if it's owned in the individual's name who owns the tax positive company, if you can follow that.
Well, a lot of people still will.
Yeah.
Some will be gone.
Then what you've got is the loss ending up in the individual's tax return because it's an LTC or they own it individually, and now you've got profit in the company. So to get the profit in the company out to the individual, you have to declare a salary, and you can't offset the salary against the loss because the source of income is now not residential property, it's salary from a company. So these are the nuances that you need to get right. Everybody thinks, loss ring fencing, there's nothing to do because you just can't claim it anymore. Well, lots of people will have exceptions to this. There are things you can do where, for example, if you've got a business, you might be able to move the debt into your business or over your business. And it's that sort of detail that you need to be getting with your accountants. Make sure they're good at this stuff, because you need someone that is above somebody preparing tax returns. Basically, you need a tax practitioner that is capable of looking outside the square and saying, hey, can we turn this around for you? Because in a lot of circumstances we're seeing clients with quite lawful tax planning opportunities that they can take advantage of to get access to those tax losses. And even though the rules aren't in, so everything I say is subject to seeing the final rules when the legislation comes through, we do know the shape of the legislation and the broad principles. So this is a broad principles discussion.
In short, to make it really basic, if you did have a company with a property making you $6,000 a year and you're making negative $2,000, then you can, if it's in the same structured company or same company, then you can offset. That's the one time you can offset the losses against the income of the year.
Yeah, so if you had, examples, company owns 10 properties, half of them are tax negative, half of them are tax positive, they're all residential, they can all offset because they're in the same company. If you split them between the company and the shareholders at an individual level, you've got to be able to get the income out to the loss in a form that is not a salary. So make a look-through company election, but when you do that, you have disposal issues. You can actually cause taxing consequences if, for example, you're affected by bright line income. Getting too deep. Then, if you've got properties in a trust and that trust is tax positive, and then you've got losses in your name, and you make a beneficiary distribution down, well, is the character of that beneficiary distribution maintaining where it came from, which was from rents in the trust, and therefore can you offset it in the individual's return where the loss is? Answer to that is probably not, because it's beneficiary income, it's not rents. But I do want to say, in making these statements, this is all draft. We're waiting for the final rules to come out of the legislation.
So when the final rules come in, or even now I guess, but especially when the final rules come in, it's going to be more so important than it's ever been to make sure you buy it in the right structure. Know what you do, which you should do anyway, know what you're going to be doing when you buy a property, but getting that in the right structure immediately will be hugely important then.
Absolutely. Another example of this, because this is a lot of people will be wondering this. A lot of people will have two companies, and you could, for example, have company one owning tax positive property, company two owning tax negative property. Can you offset the profits and the losses between the two companies? Now, under corporate grouping rules, traditionally the answer to that would be yes, if you have common shareholding of 66% or more. Company A and Company B can just swap profits and losses. And there's a process called a subvention payment, which is effectively a payment transferring the losses and profits between the companies to achieve that. Well, under the loss ring fencing rules as they are proposed, you need 100% commonality of shareholding to do that. So it's different to the corporate grouping rules. So there's another example of the nuance that comes out of these rules that on the face of it you'd think, oh, corporate grouping rules would be sensible to let you group because that's mainstream tax. But these loss ring fencing rules are a bit quirky as they've been drafted, and they're different to what we would have expected anyway. There's a lot of criticism of them, is that the drafting of the legislation's overly flowery, very unclear and unnecessarily so. I don't know why they've done that. So we're hoping that when the new legislation comes out that it's going to be a lot clearer.
As you said, it's good time for accountants at the moment with Labor. And
well, we were joking, and I was joking in the media a lot, saying a vote for Labor is a vote for Gilligan Road accountants and all accountants, because accountants would make a fortune, and so would valuers out of.
Valuers were about to add a capital gains tax.
Yeah, a capital gains tax. So the rule changes creates consultancy.
Great stuff.
Yeah, but ballsy move from the government, just canning it, because that was always going to be a hiding. Labor offended all of their base, and the Greens who were hanging out to bring in CGT, and were celebrating the idea somewhat idealistically because it's a difficult thing to do politically. But they said, let's have a go. It might cost them the election, but they wanted to have a go. And as a pragmatist and a good leader, I think she's come out and said, no, we're not going to get this through. Peter's is not supporting it. This is going to be a noose around our neck to the election. Let's cut this off right now. And she's popular at the moment, so
she still is.
I think it's great leadership from her. And in retrospect, she'll be judged well for it.
Great stuff. Well, before we move on from tax, any other upcoming tax issues that you see or hear in the background?
Yeah, well, I think one of the things you'd have to ask is, given that they haven't got CGT away, and given that they have an appetite to tax the population harder so they can spend more, in my opinion, and I'm not criticising that, I'm just saying I think that's what Labor governments do. And I must say I like a lot of the spending they do, like on social spending that they do. I'm a fan of it. I hated the way the national government ran the health system down, Middlemore leaking and that sort of stuff really was unnecessary. Not being anti-Labor, but I think that they do want to tax more, and they're going to be looking for ways to achieve that. And it would not surprise me to see them push the marginal tax rate, the top marginal tax rate, up. So, wasn't that long ago, maybe 10 years ago, the top marginal rate was 39% and the trust tax rate was 33% back then. I think we could see definite movement that way in the not too distant future. That would be my pick. Now this is purely speculation. I've got nothing to back that up. I just think this government want to tax more, and they'll be pushing up marginal rates, and they'll have to bring the trust tax rates up to match that.
I hope they're not watching the show, because they might, you might just give them ideas.
I don't need to give them any ideas on tax. They've got lots of ideas. The other thing is, I expected, as a surrogate for CGT, in the absence of it, to see longer bright line rules. And I have seen some commentary around the government saying they're not going to do that. But it wouldn't surprise me if one day bright line rules end up going from 5 years to 10 or 15 years, because it's a backdoor capital gains tax.
Well, it is a capital gains tax, yeah.
Yeah. And
I think 5 years is a long time. A lot of listeners here will be agreeing that 5 years is a long time.
Well, I mean, if your intention is to sell it within 5 years, then you're a trader. You probably should be paying tax.
Yeah.
So I don't disagree with the concept of bright line rules, because clandestine traders who sort of acquiesce as investors are being, 5 years is not very long in the investing world if you're a long-term investor.
I guess it goes back to what you said earlier on too. A lot of the, I guess, Labor supporters who have that one property, they might be intending to have it for 10 years, or their lifetime sort of thing, but situations change, interest rates go up, they can't offset their loss of taxes. You know, there might be legitimate rules in 3 years, 6 years after they need to sell.
You did right
so
there.
They'll get hit even harder.
You did right there. What might save them is that the rules are coming in a down market. So because the market is flat to declining, possibly going down, if the loss ring fencing bites the market harder, scares the market, pushes the market down further, and people are forced to sell while they're caught by 5-year Brightline rules, there's no gain, so there's nothing to tax. In fact, they'll get a loss, which they can offset against other Brightline obligations.
Right.
So it might not be so bad, and by the time the market's digested the information, it won't matter anymore. In Australia, the Australian government this month are going to election. It's May 2019, and I understand they're leading in the polls, and they're looking to bring in loss ring fencing rules. They call it abolishing negative gearing, but same thing. So they're following suit over there in Australia.
Okay.
They're also reducing the CGT. They proposed reducing the capital gains tax reduction from 50% for assets held longer term over there. So they get a 50% reduction of CGT in Australia, and they're looking to reduce that to 25% if they're elected. So they're going to tax property harder over there as well, which on top of a very recessionary property market won't help.
Not at all.
Melbourne's down 14% and Sydney a similar amount at the moment. Or was it? I think Sydney's down 14 and Melbourne a similar amount.
Yeah. Okay. Well, interesting stuff. Geez, 20 years ago, if we talked for 20 minutes on tax, people would be bored to death. But it's such a great topic right now, Matt.
even I'm bored. God, it's tax.
So that's great. A lot of issues going on and changes. As I said, we probably should have gone 6 months ago and again now almost, but we're here now. So, but we'll move on to the second part of the conversation if you want.
Yeah.
And let's talk about this event. You have a yearly event called the Property Leaders Event. Been the last two. It's always a great event with organised right down to the T. So good effort on there. And it's on the 26th of May, a Sunday. It's an all-day event, which we'll talk about in a minute. And you've got some of the speakers you have within your team, but you've also got some good guest speakers that's coming along this time, and we'll talk about that. So a full day event, and what can the people expect to hear about?
So first thing is, if you just write down www.gra.co.nz, that's our website. That's how you can find us for introductory tax meetings. But it's also where you can find under our events tab this Property Leaders event. And as Mark was explaining, we do an annual event where the tickets are cheap as chips. They're $55 for a full day. That includes morning tea, lunch and afternoon tea. And actually, after we pay the event costs, we lose money on that. There's typically 500 people in the room, and we do it for branding. We do it because we thoroughly enjoy running this event. And what we do as a practice is we identify leaders in the community who have got something to say that you can take from the event, take home and apply at home. Now, of course, we've got one speaker that is very high net worth, and he's building 600 houses a year, Kenyon Clark, who's had an interesting past actually. His slot is
It'll be worthwhile listening to.
Well, I'm labelling it hero to zero to hero, because the guy owned, I think it was Ideal Electrical, and there was $100 million plus business, and then during the GFC, his banker went broke, Bossy Bank, and then that business collapsed, and he had some terrible financial consequences and went to zero. And in fact, I understand went bankrupt. And then came out of bankruptcy and started a very large business, Duval Group. And this year he's building 600 apartments, and he's got a forward book building 600 apartments a year every year. That's his target. And he's had some international investors come in and buy a big chunk of his business, and he'll tell his story. But he's hero to zero to hero. And I found him I found his story quite inspiring. I didn't know a lot about him. And in fact, I'd crossed crossed wires with him on Graham Fowler's website, and I actually had a bit of a dust up online.
Had a wee bit of a laugh about that, Matthew, but that's another story.
But then he and I PM'd each other and said, let's have a beer, and we did. And I thought, God, you're not the guy that I thought you were. Actually, it just goes to show you shouldn't judge a social media post by its cover.
I believe he was in the Wall Street Journal many years ago, and you don't get on that by accident. So
he's a player.
So he's a player, well worth listening to.
And he's high IQ. He's really intelligent, and I was super impressed by him as a businessman. So he's going to tell his story, and it's quite interesting. So that's Kenyon Clark. We've got a few more people. Tua Sarsevi, who is a regular at the event. He's a full-time property trader, and he's got war stories from the street in Auckland, and his group's making some really good money at the moment, and so he's going to tell you about how they're doing that from trading, and also killer deals for buying and holding happening in Auckland, because Auckland's gone into the downturn before the rest of the country. So we are well and truly in the downturn now, and there's some great buying around. And in the same vein, we've got Andrew Bruce, who's the Auckland Property Investors Association president, and he's also going to be talking about how he started in the down market and made a lot of money in the down market. Only last cycle, he's one cycle through, but he's made a heap of money. And his story is about cash flow, because his whole focus is about lifestyle. And I was with him this afternoon. He told me that he works 15 hours a week at a push. He's
a terrific bloke, he is.
Yeah, he used to be a professional tennis player, and he's a hell of a sportsman, a very competitive sportsman. And so he plays golf a lot, and he's got a phenomenal portfolio that he's built, and he's going to be telling his story. And the whole theme of this 2019 Leaders event from GRA is thriving in the down market. So, Andrew Bruce, Kenyon Clark, Tua, these guys are thriving in the down market. Now, one of the challenges for the down market is finance is tighter. The banks see the markets becoming more volatile, they tighten the purse strings, and that adds to the volatility in the downturn. And Chris Pedersen is going to be talking about, from Chris Pedersen Mortgages, about some new finance products he's got that are absolutely a game changer. And I'll let him tell his story. But right now, debt servicing is tested. Even if you're on 4% cash flow, they stress test you at 8% principal and interest over 30 years. So if you've got $1 million of debt, you're paying 40 grand in interest, but they're stress testing you on the basis of 120 grand is the required cash flow you'd have to have free to cover the hypothetical loan of 8% P&I over 30 years. And that's a massive difference, So he is going to talk about a new product that he's developed that stress tests in the mid-5s, and it's game changer. So all of my investors around me are very excited about that, and there he is on the phone right now. he's calling right now. His ears are burning. So he's going to talk, and he's also got some second-tier stuff for people, and he's got some good common sense advice on where he sees interest rates going, looking at the changes to the capital adequacy ratios and so forth. So I always enjoy Chris. He's got a good strategic view of the market. Now, another friend of mine, Nicole Wilson, from a small company called Property Pathfinder, is sort of a champion of the unitary plan, and she is very good at taking small sites, maximising profit out of them, and she's got some war stories showing how a lot of people are getting development approvals, resource consents, for things that don't make any money.
Yeah.
And they miss the most important step, which is how to assess a site at the beginning for its profitability. And most sites don't make any money, you shouldn't touch them. So she's going to show us some examples of developments that she's been buying for people that are really profitable, and also a bunch of developments that she hasn't bought for people, or that she's seen other people buy that are not making money.
What I like about her, I know about her, is you'll go there with a plan to give to her, and she'll won't even look at the plan. She'll do her own to see if it works.
Yeah.
Which is great.
Yeah, that's about options, considering the different options and going through them. Now, last but not least, we have David Faulkner. Actually, second to last, David Faulkner, who is a property tenancy expert. He's a trainer of many property managers around the country, and he's a really good speaker, and he's absolutely top shelf on tracking the tenancy tribunal cases and looking at threats to landlords. And so he's going to come and share with us his view of threats to landlords, and he's also going to cover methamphetamine as an issue and tell us where that's going.
Right.
Actually, last but not least, and probably the first speaker is Jared Edge, who is the Kiwibank Chief Economist. And in the last few years, we've been running Tony, and Tony's great. We'll still have Tony along to Gilligan Row events, but Jared has a different speaking style, but I've found him very intuitive and very good to listen to on the economy. So we want to give him a bit of a run this year because I've listened to him and I sit up straight in the seat and think, geez, this is a really good economist, an emerging economist in New Zealand. And I think his presentation style is excellent for property investors.
I've listened to him once and also had him on a podcast, and he is, if you're sitting there and go, economists away, speaking up there, he speaks to your level, and and it makes it so simplistic, and you can understand.
Yeah.
If you're a newbie investor starting out, you'll go, wow, I understand this bloke.
He's really practical, and when I ask him questions, he actually answers them. Like a lot of the economists dodge the questions and say, could be this or could be that, but he'll say, I think it's going to do this, and these are the reasons why I say that.
Jared Kerr, I think you said Jared Edge.
Oh, yeah. Jared Edge is my HR manager. Whoops. Yeah.
I thought, Jared's talking.
Jared Kerr. Yeah, thank you.
So there's that's it. There's no Matthew Gilligan speaking.
Oh, yeah. I'm MC, and
What's your main focus or topic?
I'll probably show a few of the developments that I've been doing because I'm working in that area at the moment. Probably talking about a bit of the property trading I'm doing at the moment, which I'm doing with some clever partners down in Christchurch and Central North Island, and probably just give a bit of a big picture of the market and just remind us all of what property cycles do and how much value and opportunity there is in a down market. There's so much money made in the down market. You get paid in the up market, but you make the money by getting the assets to the down market.
Absolutely.
Yeah. So if you'd like to come to the Property Leaders event, www.gra.co.nz, or if you'd like a hand with your tax, book in for a tax consultation. And Mark, in closing, thank you very much for having me on your podcast again.
Always a pleasure.
Gilligan Row, appreciate it. And right back at Mark here, best real estate agent online, and has a massive pile of investors, including lots of my clients that respect him and like him, and buyers houses that he lists. So check out his website. What is your website address?
Propertyventures.co.nz.
Yep.
Some people here will be watching it there, though some will be on just Googling the New Zealand Property Podcast. But come and see us, and we like to surround ourselves around good, successful people that know the business. So that's why we're both sitting here today.
Thank you, Mark, and hopefully we'll see you May the 26th, which is a Sunday.
Great stuff. Hope to see you there. I'll be there. And thanks again for watching, and we'll be back in 2 weeks with another special guest like Matthew here. Thanks very much.
Thanks for listening. Good night.